Recessions. They can feel pretty terrifying, right? You see all the headlines screaming crisis, and it feels like the sky is literally falling. But here's a wild thought. What if those moments are actually one of the greatest wealth-building opportunities in disguise? Well, today we're going to break down exactly how to navigate a downturn, not with fear, but with a clear, calm playbook. So let's get right into it.
All right, and before we go any further, just a quick but really important heads up. This is all for educational purposes. It is not financial advice. Investing has risks, so it's always a good idea to chat with a licensed pro to get advice that's tailored just for you.
So picture this. It's March 2009. We are at the absolute rock bottom of the great financial crisis. The world is in a full-blown panic. And right then, Warren Buffett writes this simple, powerful line for the New York Times. While basically everyone else was selling everything they owned, Buffett, he was buying.
And the result of that move? Well, this number says it all. From that absolute low point, the S&P 500 shot up by about 400% over the next decade. Wow. It just perfectly illustrates the core idea we're talking about today, that fear creates incredible opportunity, but only for those who are prepared for it. All right, so here's our game plan. First, we'll cover the anatomy of a recession. Then, we'll get into the market's secret language. After that, we'll talk about 5 costly investor mistakes, and we'll wrap up with your very own recession investing playbook.
Okay, first things first. Let's define what we're even talking about. Before we can build a strategy, we've got to know exactly what a recession is, right?
So the technical definition is actually pretty simple. It's just 2 consecutive quarters. That's 6 months of negative GDP growth. And GDP, or gross domestic product, that's just a fancy way of saying the total value of all the stuff and services a country produces. So if that number goes down for 6 months straight, boom, officially we're in a recession.
So what actually causes these things? Well, it usually boils down to one of 4 main triggers. You've got big financial system shocks, think the 2008 crisis. Then there are external shocks like the COVID-19 pandemic, which kind of came out of nowhere. You can also have policy mistakes, maybe the central bank raises interest rates way too fast, and of course the classic, an asset bubble bursting like the dot-com bubble back in 2001.
Now, I know when you're in one, a recession can feel like it's going to last forever. But, history gives us a bit of perspective here. The average U.S. recession since World War II, it's only about 10 months long. The key takeaway? They're a normal, cyclical, and most importantly, temporary part of the economic cycle. Okay, so knowing that recessions are temporary leads us to our next point, and honestly, this might be the single most important thing you need to understand as an investor during these times. And it's this: the stock market is not the economy. They really do speak 2 completely different languages.
So here's the difference in a nutshell. Think of the economy as the rear-view mirror. All the data we get, like GDP or unemployment numbers, it tells us what has already happened. But the stock market, that's the windshield. It's a forward-looking machine, constantly trying to guess and price in what it thinks is going to happen 6 to 9 months down the road.
And check this out, because this timeline is where it all clicks. The market usually hits its peak before the recession even officially starts. And this is the kicker. It usually bottoms out and starts its recovery when the economic news is still absolutely terrible, long before the recession is officially declared over. What does that mean for you? Well, it means if you wait for the good news to start investing again, you've already missed a massive chunk of the recovery.
And look, if there's one fact that should help you sleep at night, it's this one. Every single U.S. recession since 1945 has been followed by a market recovery that went on to hit a new all-time high. Every single one. So you see, the question isn't if the market will recover, it's just whether you'll have the discipline to stick around for it.
Okay, so now that we've got the lay of the land, let's talk about what not to do. Let's talk about the traps. These are those predictable, emotional mistakes that just destroy wealth during a downturn. But the good news is, you can totally sidestep them if you know what to look for.
Okay, here are the big 5. First up, panic selling. This is the classic mistake of turning a temporary on-paper loss into a permanent, real-life loss. Number 2, trying to time the market. It's a fool's errand. Seriously, you have to be right twice, when to get out and when to get back in. Good luck with that. 3, checking your portfolio constantly. That just fuels anxiety and leads to bad emotional decisions. 4, abandoning your plan. You made that plan for times just like this. And finally, number 5, taking on debt to invest. This just adds a ton of risk right when your job or income might be the most fragile. And hey, if you're still not convinced about trying to time the market, check out this number. Studies have shown that if you miss just the 10 best days in the market over a 20-year span, your returns get cut by about half, 50%. And the craziest part? Those best days often happen right after the worst days, right in the middle of all that fear and chaos.
All right, enough of the don'ts. Let's flip the script and talk about the do's. This is the good stuff. This is your actionable playbook, the strategies that can turn a scary recession into a seriously powerful opportunity for your financial future.
Okay, the absolute core principle, the number one rule is just keep buying. That's it. It's a strategy called dollar cost averaging. You just continue your regular automatic investments into broad, low-cost index funds. You have to reframe your thinking here. A market drop isn't a crisis for you, the long-term investor. It's a sale. It's a Black Friday sale for stocks. You're getting to buy the same great assets just at a huge discount.
And here's a super simple example of how powerful this is. Let's say you invest $500 a month, right? When the price of a share is $100, your $500 gets you 5 shares. Simple. But when the market drops and that price falls to $60, your same $500 now buys you over 8 shares. You're getting more for your money. This is how you accumulate more assets when they're cheap, which just turbocharges your growth when the recovery comes.
Now, beyond just index funds, there are a few other things that can help you weather the storm. Dividend-paying stocks are great because they can give you a little income stream even when prices are down. Bonds and treasuries can act as a safe harbor, a place to park some cash. And speaking of cash, having some in a high-yield savings account gives you that safety, plus the flexibility to jump on opportunities. And, for those with a bit more of a stomach for risk, you can look for individual, high-quality companies that have just been unfairly beaten down.
It also helps to think about which parts of the market are just naturally more resilient. We call them defensive sectors. Think about it. No matter how bad the economy gets, people still need to buy food and soap, they still need medicine, and they still need to keep the lights on. That's consumer staples, healthcare, and utilities. On the other hand, things like luxury goods or even banking, those can be a lot more vulnerable when people tighten their belts.
Okay, but listen, before any of this investing stuff can work, you absolutely have to secure your own foundation first. This is non-negotiable. I'm talking about your 3 to 6 month emergency fund. That is your number one asset. It's the firewall that keeps you from having to sell your investments at the absolute worst time. Beyond that, strengthening your position at work and getting rid of high-interest debt, those are absolutely critical moves.
So, if you take away just one thing from all this, let it be this. Recessions are inevitable. They're a guaranteed part of the investing journey. They're going to happen. But panicking, that's optional. Panic is a choice, and it's a choice that will almost always cost you.
At the end of the day, it's the calm, prepared investor, the one who sticks to the plan, who reaps the rewards of the eventual, and yes, inevitable recovery. So I'll leave you with this to think about. Were you investing during the downturns in 2020 or 2022? And what was your experience? What did you learn? Something to chew on. Thanks so much for watching.